still seeing oil and gasoline in the middle of its risk range, so it's not quite there at the lower end of the risk range. I should also discount copper. Copper is getting hit from China. It's going towards the lower end of its risk range.
Well, good morning. Got another day. Made money yesterday.
If we next just look at what happened in Japan,
I've managed to not lose as much as the indexes over the last couple days, so if everything straightens out, which it looks like it will or it won't. I'm looking at, of course, the S&P, looking at the NASDAQ. Well, it is toasty. What the fuck? Here we go. It is absolutely toasty. 72 degrees in the morning here in the Pacific Northwest. Hot, hot, hot. It is an oven. There's a little bit of humidity, so it makes it a little bit worse. I could not imagine being in somewhere like Texas. Florida's a little better because, like, it'll rain. But then it gets really humid. But, yeah. I mean, I'm from the South, and it's pretty hot and humid. But it just doesn't get this hot. Except for maybe Texas. And that's a terrible combination. Heat and humidity. And then I guess in West Texas it's just heat and exposure. Alright. Alright. So what do we got? I guess I'll put the camera on.
Cool, thanks Ryan. Thank you Taylor. Figured morning was just the insights on consumer finance land. The middle of the month or the 15th of the month, so we're getting credit card asset quality data on a managed and truck basis. So this morning, we got Capital One, Tiffany, Discover, and JP Morgan. So if we look at this first 5 years, this is the first part of our table focusing on delinquencies, and we can see delinquencies across all four of the issuers that reported this morning. We're up sequentially, up year over year.
How do I turn the camera on?
So that second half of that table, as you see it red, if the text is red, that means
Deactivate, activate. There I am. Looking kind of rough. Got my Braves shirt on because they beat the Yankees, obviously. I mean, this stuff doesn't mean anything to me, but, you know, obviously, if it were. So it is hot. Can't cool off. Let's try to get some air in here. But yeah, it like won't cool off until like 5 a.m. The land will cool off to like 70. So today's a concern because it didn't cool down. So yesterday we hit the high of this hot spell at like 108. It is apparently it's 72. My walls are hot because it didn't like break below 90 until like well beyond you should be asleep. So like one of my cats slept with me, which obviously was the smart cat. And then the other cat, like, I'd walk out into the part of the unit that we're not cooling, and I just had the windows open because, like, you know, it will cool off at some point, but that point is 5 a.m. And so, like, every time I check on the other cat, she's just sprawled open. But at least, you know, it was probably a lot quieter in where she was versus where I had the air conditioning. But another super hot day today. Alright. We'll see if I can focus. Who knows? Alright, let's change. Let's update our active list. Okay. AAAU, AMLP, Activision. No Bath and Body Works. Carnival. Base metals. Base commodities. No more Donkey Kong. DraftKings. EDU, EWJV, FCX, FITB, IJR, India, Minnesota, Moo, NYCB, PBR, PCT, Roku, Tel, WIT. Alright, we're all there. So for the big stocks, Apple, AMD, ARKK, EEM, EWZ, GDX, Microsoft, Tesla, and XLU are all bearish. I don't know. Yeah. So I wouldn't. I mean, you might do like a call day trade in Meta.
produce on the other side is a sustained period of credit outperformance. Now, what we have here is this sort of kind of reverse boomerang effect, which in the pandemic was really the mother of all bailouts for that more vulnerable segment of consumers. And, you know, many in that segment sort of got used to the milk and honey of that period, and now the reality of inflation.
But I don't think you're going to get a chance to buy Meta today. Not after it closed at the high.
And then, of course, you have the sort of cumulative nature of this inflationary environment. And we spoke about that in prior slides. You know, it's an invisible attack that affects everybody uniformly. And it's cumulative. And we, you know, the sort of effects of that are less known, let's say, the relationship between price.
All right, let's get our overbought, oversold.
On the basis of, you know, strong loan growth, NIM pressure, you know, these issuers source a not insignificant share of their funding from deposits. Discover has really built out their deposit franchise over the past few years, so that is especially the case for them. Security and credit.
Maybe.
And this sort of
Maybe.
additional regulatory tail risk, which is get into here, but regarding late fee cap on credit card late fees, and obviously card issuers, particularly like Discover, the one who has a portion of the revenue from late fee income. And you know, as for the macro insight, I guess this really this is a look at sort of the, you know, the situation within kind of the lower rung of the consumer economy, and obviously we're seeing cracks showing there, and it's kind of reinforces this full frame that we've been this past period. So that's everything for me. But
we have a lighter queue today, so I got a question for each of you. And we'll tap it out there. But Mary, John, I'm actually going to send it back to you. This is from Mary T. Christian Drake knows that the rate of change for bankruptcies and foreclosure should be looked on a 2-year average basis. And since it's normalizing those stimmy effects, it makes sense and led me to ask, what is the 2-year average rate of change for GDP? I don't know if you have the 2-year average rate available for the GDP, but if you do want to comment on anything related to the dollar or GDP now.
Yeah. What do you think about that?
switch the line or pull that up.
Yeah. The next thing we've got, so Jimmy Whitaker is asking, did Bitcoin go from bearish to neutral? And I know we touched on it last week on Wednesday.
All right, oversold. What do we got? Wheat. Yes. Little Natty Bow. Natty Bow. I hate the name Bow. Hate bows, bow and arrows, bows, and hair clips. All right. gold.
Still looking up that one, and I think you just kind of touched on it as well with the last commentary. You want me to kind of hold off, or you want me to go ahead?
Copper.
Yeah. So, in the
That crude is kinda. No, be that. Natty Bow. Alright. What is overbought? Overbought. 2-year yield.
average in real growth, that's, and the change in that 2-year average, that's going to
That's it.
ensure some of this
What is almost overbought?
pandemic kind of distortion, right? Because that's going to include, you know, the 2021
Dollar yen maybe.
sort of growth rate, and obviously, you know, that those growth rates are not sort of normalized growth rates. So I probably look at 3-year, you know, for sort of a more kind of
That's about it. Okay.
for a cleaner look at the sort of change in kind of sort of real growth from a base rate standpoint. But in the third quarter, you know, we have the 2-year comp easing from about 7.13% to 3.45%, and then on a 3-year basis, you have Bitcoin from 1.9% to 1.62%. So both easing there, but of course, you know, our nowcast model is driving our third quarter estimate, and we need to take the best to forecast for the outward period, for which, you know, data obviously drives things.
So this one last one is going back to Dan Moby's asking, excuse me, why do you think you've missed a strong consumer? Retail sales surprising into the upside, even as hedge funds consumers are slowing. There will be polar raises for Social Security. More importantly, what's the need going forward? And I think we can kind of look at it. It's not that we even missed the strong consumer. It's we're just highlighting what's going on with delinquencies, what's going on with millennials and Gen Z. I just think we maybe it's a timing thing, but you want to go ahead and talk on that?
Yeah, so, you know, obviously.
Yeah.
We've had this kind of confluence of this excess liquidity dynamic. Obviously, you know, during pandemic period, consumption was effectively halted, and between, you know, government transfer payments and the ability to go out there and consume on a discretionary basis, that resulted in an ethically high savings rate, and, you know, notwithstanding sort of this inflationary backdrop, you know, the effect of that has really sustained consumption. And, you know, we also have this pandemic kind of YOLO zeitgeist, right? You know, people were locked down either through, you know, government decree or through just, you know, everyday kind of fear and worry. And, you know, now they're kind of going out and, you know, consuming for those prior periods. And then, yeah, you know, obviously the COLA benefit is a factor, and sort of, you know, recessionary level government spending, you know, that flows you know, consumption, COLA benefit being an example, and so, yeah, you know, I'd say the combination of those things. But if we look, for example, last quarter, consumption did slow, right? Really did slow. It was really government spending that pushed purchasing of Quad 1 or pushed the acceleration. So, you know, we're not like all of that confident in the consumer, and to the degree, you know, we've got the consumer on, I think that's
Burr, 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 burr.
That's the message.
And we had one just come back in and kind of moves two, but it's going to pair it into one. So you, Ryan, real quick. Peter's asking about the risk range for Argentina. I don't think we provide that, but if you have anything on the ETF front for Argentina or whatever you're seeing along with Brazil, and pairing that also with the steel component, SDLG from Mike in Canton, Ohio, asking about SDLG in China rate. So I guess if you kind of want to talk about a little bit of South America and steel.
Argentina, you don't have risk rates on there. Having from that, sure. What we do have is quads for that. There's 3 quad ones coming up, and one of the best rated things.
All right, let's fucking rumble.
So it's gonna still be negative. So
Japan, putting a nice quad one economic acceleration of 6% quarter over quarter. It was a massive beat relative to expectations for 3.1%. We highlighted in our risk ranges that the Nikkei remains bullish trend, and we like our long and short in Japan.
Damn. All right, open up down. Carnival looks like a trim. No, it doesn't. All right, PBR is a trim.
Completely opposite side of the story than Japan. We had
Wow, PBR, big rippo. PBR is a close.
July retail sales ended up disappointing.
Okay, Miniso almost. All right, so PBR is the only thing right now.
On one hand, you've got Japan.
I'm all out.
On the other side, you've got Japan.
Roku, time to close.
The last thing for rates,
Maybe not. Okay, maybe not.
he gave a real big broad breakdown of how that is setting up. So with that, and continuing that theme, our long USD position is showing signs of being overbought, and as a result, we're continuing on that process. With that, I will toss it over to you boys, and get going.
alright. First, so let's just get right after. I'm just gonna do a quick update. So you got yields, right? You can see that from first chart. Yields at the top end of the risk range, you see them at the bottom end. And that chart, there's a yield, 10-year yield. You can also see the dollar overbought there as well. 109 access, and then you also have gold. We're closer to the low end of the risk range with all of that. Still in a bullish trend, but just the next slide here, because if you actually a lot of equity in the area. Short. In terms of kind of big trend signal, we get Bitcoin we're seeing at neutral, Nasdaq went to neutral, S&P went to bearish trend. We got Shanghai went to low end of the risk rate this morning, bearish trend. So next to where we had, obviously, I know you guys can't see it too well, but just giving you all the extreme eyeballs around but ones that we have positions in are SHG and UTA. This is our eyeball premium. Although the gasoline world, we're still seeing oil and the gasoline below this risk range, so it's not quite there at the lower end of the risk range. On ourselves, copper is getting going towards lower end of the risk range. On the bearish side, we've been stealing that high side won't discount. And you have about 20 other.
All right, putting in a buy order at 124.80.
We got just look at what happened in Japan. Very large acceleration. We got that quadrant, right? Showing a little bit more spirit signs. If you go next to now, it's Chinese data. You see that flag line? That was a retail sales where it came from to where it is now. I think that was about up to 20% to about up now. So, big deceleration.
Trim some Miniso.
A little bit of a panic after seeing those numbers. cut the 1-year rate surprised me this morning. Cut 2.5%. Then next position is Germany. Their economic sentiment came off of what was about the lows of October 2022. 1-month acceleration is hold. The bigger thing there is current conditions in down. Kind of large.
All right, I got filled.
So we move on just next to the UK employment data. They had a surprise to the upside. More unemployed people. Don't want to see that start to go up. That's not good.
All right.
Their unemployment rate went to 4.2%.
Something switched an audio source. I don't know.
A little bit of acceleration in unemployment for the UK. That is all I got.
All right, there we go. Talking a little bit about that.
Cool, thanks Ryan. Thank you Taylor. So I figured this morning we'll just cover some of the insights from consumer finance land. The middle of the month or the 15th of the month, so we're getting the credit card asset quality data on a managed and trust basis. So this morning we've got Capital One, Synchrony, Discover, and JP Morgan. So if we look at this first slide here, this first part of our table focusing on delinquencies, and if we can see delinquencies across all four of the issuers that reported this morning. We're up sequentially, up year over year, on an accelerated basis. So that second half of that table, as you see it red, if the text is red, that means the delinquency rate is higher than the prior year quarter or the prior year month. And if the cell is shaded sort of towards the red end of the spectrum, that means that increase is increasing. So kind of a second derivative proxy. So we have accelerating deterioration in unsecured consumer credit. That's the takeaway there. Focusing in on the next slide, we're going to focus in on Capital One and Discover, and that's obviously because they have elevated exposure to sort of lower income and less credit-worthy borrowers. So if we want to see where changes are happening on the margin, and you can see here that delinquencies are gaping higher versus the pre-pandemic baseline, proxied by 2019 levels. That's the chart on the left showing 30-day plus delinquencies. On the left showing net charge-offs, which have just this month surpassed the pre-pandemic levels for the first time. On the next slide, we can see a longer dated time series of those 30-day delinquencies, and the red line represents the pre-pandemic historical average. And you can see that this narrative of kind of credit normalization is now becoming one of credit deterioration, because that series is really hockey sticking up and to the right, and there's no sort of sign of moderation or sort of slowing there. And we'll discuss reasons as to why we think that is later on. Next slide, the same sort of start pairing for Discover. You can see the same phenomenon, 30-day plus delinquencies, getting higher in July versus their pre-pandemic baseline. Same dynamic with charge-offs, which, kind of point of note, we have on the financial team both Capital One and Discover on as best idea short. A big part of the thesis there is this, phase transition from credit normalization to credit deterioration. And obviously, a company like Discover has sort of the added headwinds of these kind of regulatory issues that found itself in. Obviously, last night, the company announced the abrupt departure of this veteran multi-cycle CEO. I think he was at the helm for about 25 years or so.
Buying
That's quite a
defenses,
process.
defensives,
Received positively this morning.
defense.
The stock is down about 8%.
We're buying war machines.
Next slide, just a longer look at 30-day delinquencies. The red line indicates the pre-pandemic historical average. And again, the takeaway here is, sort of this transition from normalization to deterioration is abundantly clear. That right side of the chart is, kind of monotonically rising up and to the right. This next slide, we're looking still at loan growth for both issuers. And you can see loan growth is slowing. It peaked, sometime in late 2022, and it's been sort of steadily decelerating. You can see on the next slide, the 2-year base effect really steepened over, the next
Whoa.
6 to
Okay.
9 months. And
Different account.
The next 2 slides here discover card loan growth. We also see that late 22 peak rollover. And the next slide, we see those steepening base effects. And the implication of this is that, we've talked about the denominator effect with respect to delinquency. So, when you're rapidly growing your loan book, that tends to sort of suppress, artificially suppress the delinquency rate, and then when loan growth slows on the other side, and that back to season, you tend to get a more pronounced rise in delinquency. So we think this slowing loan growth, which is going to be mechanically driven by base effects, but also by the everyday effects of credit tightening. Obviously, the average rate on credit card debt is, hit another all-time high last month, and bridging those sort of real income gaps with kind of unsecured revolving credit becoming more and more costly. So that's going to play into slowing loan growth as well, and that's obviously going to exacerbate the credit part of our thesis here on these 2 names. Just sort of next slide, trying to get under the hood a little bit and really think kind of why we're seeing this credit deterioration with Discover, Capital One. Again, obviously, they're more indexed to lower income and less creditworthy borrowers. And, obviously, everyone knows these stats, the percentage of Americans, obviously, it worsens as we move down the demographic ladder. We are effectively living paycheck to paycheck, notwithstanding, some of the spending data that we've been seeing. Next slide, slide 11, the next slide here, looking at real average hourly earnings growth. We had previously flagged that this figure had been negative for 25 straight quarters. And, while it has, as sort of headline inflation has rolled over, subsequently in July, obviously, this figure turned positive, but it's important to note that 25 straight quarters negative real earnings growth.
Buying some small cap oil and gas.
Not to be discounted, and that's still very much, working its way through the system on a lag, especially as it pertains to, credit performance. Next slide, sort of a CPI snapshot from last week's release.
It's a natural gas play. Natural gas is oversold. I'm gonna actually get a little bigger.
Goods and used car values. And as we see on the next slide, obviously we've spoken about this kind of flattening out, flattening out to easing base effects over the next 6 to 9 month period, and the implications of that for kind of a high inflationary outlook. On the next slide, obviously.
Yeah, natural gas is bullish.
begin to ease, quite significantly here over the next, also 6 to 9 months, and we're seeing in real time with market data that we're getting energy reflation. Of course, that's not going to bode well for sort of the disinflation that's kind of really required to get us back to this kind of steady state 2% inflation level. Compounding these issues.
We've got an air quality alert as well as a heat alert.
Sticky inflation above trend growth in these core consumer confidence is not positive, and layering onto this, we have the resumption of student loan payments this fall in September, and that's obviously
Well, we might not break 100 today.
debt servicing that's going to come online, and that's going to erode consumption, and it's also going to erode debt servicing capabilities for credit card borrowings, and credit card borrowings are just compete against student loan borrowings and all other borrowings for repayment. Next, just last week, obviously we saw that top in initial jobless claims. That's beginning to, it looks like, bounce off its pre-pandemic average in the light blue line. And really sort of taking kind of a bird's eye view here on this next slide and recalling some of the words, the whys. We have kind of a number of sort of dynamics here. This is just commentary from Richard Fairbanks, who is the CEO of Capital One. He's a total veteran of the credit card industry, and he echoes sort of our thinking with respect to unemployment and changes in the condition set, and it's really the rate of change that matters. And actually, their credit underwriting models, or provisioning models rather, are driven by the rate of change in unemployment much more than the absolute level. And so on that previous slide, as we begin to see the employment picture change on a rate of change basis, that's obviously going to be more pronounced given the sort of depressed levels we're coming off of.
Natural gas is oversold. I may want to get pretty big in Tellurian.
Their underwriting and provision expense, given this rising delinquency and charge-off dynamic. And second, we really like this framework, this sort of catch-up effect, and that the idea there is that periods of prior credit outperformance beget future periods of credit underperformance and vice versa. So obviously the GFC or the example is that you had a situation where you had a financial crisis and economic crisis, which together pulled forward charge-offs and delinquent borrowers, and really washed out that kind of weaker segment of borrowers and consumers, and what that produced on the other side was this kind of sustained period of credit outperformance. Now what we have here is this sort of kind of reverse boomerang effect, which the pandemic was really the mother of all bailouts for that more vulnerable segment of consumers, and many in that segment sort of got used to the milk and honey of that period, and now this new reality of persistent inflation is really sort of beginning to set in here, and that vulnerable segment is those cracks are beginning to show again, and that's really what's driving this sort of uptick higher in delinquencies from on behalf of Discover and Capital One, right? It's sort of paying the price for the pandemic period outperforming. And then, of course, you have the sort of cumulative nature of this inflationary environment, and we spoke about that in the prior slide. It's an invisible attack. It affects every.
So I've got almost a 2% position in Tellurian.
And the sort of effects of that are less known than, let's say, the relationship between rises in unemployment and rises in
all right, let's call this one out on Twitter.
So just, I guess the takeaway includes kind of our thinking on the credit card space. We like Discover and Capital One on the short side, and we, on the basis of slowing loan growth, NIM pressures. These issuers source a not insignificant share of their funding from deposits. Discover has really built out their deposit franchise over the past few years, so that is especially the case for them. We're credit, and this sort of additional kind of regulatory tail risk, which we didn't get into here, but regarding late fee income and caps on credit card late fees, and obviously card issuers, particularly the likes of Discover and Capital One, derive a non.
Let's see, what is Intero?
Late fee income.
Yeah.
And as for the macro insight, I guess this really gives us a look at sort of the situation within kind of the lower rung of the consumer economy, and obviously we're seeing cracks showing there, and it kind of reinforces the simple frame that we've been using over this past period. So that's everything for me. But
we have a lighter piece. I got a question for you, and we'll tap it out there. But John, I'm actually going to send it back to you. This is from Mary T. Christian Drake notes that the rate of change for bankruptcies and foreclosures should be looked on a 2-year average basis. Parentheses normalizes on stimmy effects. It makes sense and led me to ask, what is the 2-year average rate of change for GDP? I don't know if you have the 2-year average ready available for the GDP, but if you do want to comment on anything related to the dollar or GDP now,
let me, if you can just switch to Ryan while I pull that up.
Yeah. Okay. The next thing we've got, so Jimmy Whitaker is asking, did Bitcoin go from bearish to neutral? Now I know we touched on it last week on Wednesday, the key that Bitcoin moved to neutral a little bit, but on anything that you're seeing on your end, or any of the other things you want to comment on that?
Sure. Bitcoin was bearish on 8.8 and been neutral ever since. Neutral ever since then. I guess you look at our crypto product rate, Ethereum is bearish, Solana is neutral, so you're kind of getting mixed signals here. Yeah, MSTR went neutral, for PLOK, ETF there was still bearish, so kind of mixed signals, some bearish, some neutral.
Okay, I like that. And I did actually, so John, I apologize, I'm going to time for you with 2 back to back, so
I am gonna make some fucking coffee. Is my Tellurian price? So I'm up on all my buys in Tellurian today. Tellurian.
So, in the third quarter, one thing you have to keep in mind with the 2-year base effect for GDP growth is that it's going, particularly in the third quarter, but really this is true up until basically the second quarter of next year. So in the third quarter, if you look at the 2-year
PCT Pure Cycle Technology is oversold.
average, that's going to feature some of this, pandemic kind of distortion.
50 basis points, thank you.
Include,
All right, what do we beef up there?
2021
fiber
the
and
2022 third quarter growth rate, and obviously, that, those growth rates are not sort of normalized growth rates. So I probably look at 3 year, for sort of a more kind of for a cleaner look at the sort of change in kind of sort of real growth from a base rate standpoint. But in the current quarter, you have the 2 year comp easing from about
oil field services. Yep. Crude is now oversold.
And then on a 3 year.
Hell yeah, hell yeah, hell yeah, hell yeah. We're getting some good stuff today on sale.
So both easing there, but of course, our nowcast model is driving our third quarter estimate, and we lean into the base of that producer forecast for the quarter period, for which data obviously drives it.
Awesome. So this one last one, it's going back to Dan Moby's asking, excuse me, why do you think you've missed the strong consumer? Retail sales surprising into the upside, even as hedge fund totals consumers are slowing. Could it be the COLA raises for Social Security? More importantly, what's it mean going forward? And I think we can kind of look at, it's not that we've even missed the strong consumer, as you were just highlighting, what's going on with delinquencies, what's going on with millennials and Gen Z. I just think it maybe is a timing thing, but you want to go ahead and talk on that?
Yeah, so, obviously employment's been resilient, and you've had this kind of confluence of this excess liquidity dynamic. Obviously, during the pandemic period, consumption was effectively halted, and between, government transfer payments and the inability to go out there and consume on a discretionary basis, that resulted in an ethically high savings rate. And, notwithstanding sort of this inflationary backdrop, the effect of that has really sustained consumption. And, you also have this pandemic kind of YOLO zeitgeist, right? People were locked down either through government decree or through just, everyday kind of fear and worry. And, now they're kind of going out and, consuming for those prior periods. And then, obviously the total benefits.
We got Pinduoduo oversold.
Level government spending, that flows into, consumption, COLA benefits being an example. And so, I'd say the combination of those things. But if we look, for example, last quarter, consumption did slow, right? Real PCE did slow. It was really government spending that pushed or pushed us into quad one or pushed GDP acceleration. So, we're not like all that confident in the consumer, and to the degree, we've gotten the consumer wrong. I think that's much less than, let's say, the miscalculation of government spending. But that's the thinking there.
Great, thank you. And we had one just come back in. It's kind of, well, it's two, but it's going to pair it into one for you, Ryan, real quick. Peter's asking about the risk range for Argentina. I don't think we provide that, but if you have anything on the ETF front for Argentina or whatever you were seeing along with Brazil, and pairing that also with the steel component, SDLD, from Mike in Canton, Ohio, asking about SDLD with the China rate cut. So I guess if you kind of want to talk about a little bit of South America and steel.
Argentina, we don't have a risk range on that. That is from that piece for sure. What we do have is the quad sub, so that's really 3 quad ones coming up, and one of the best rate of changes in terms of their GDP growth, although it is going to still be negative. So it's going to go from, we have it projected around -4 to about -2% or something like that. But no, I don't have a risk range on that. Then you mentioned Brazil. I know we added it to ETF Pro. and he saw his re-rate. And then, again, I don't have the risk rate, I'm not either. But with inflation and the oil, it's 40% of that ETF Petrobras. So, yeah, I don't have risk rate there. Then your third question on that was steel. Oh, steel. So I think the ticker you mentioned was Steel Dynamics. I think Jay covers that. Although I know from Heath on SLX, it's the ETF for like steel producers. You have your eyeball discount in there, and I think that's been bearish on steel. Other than that, I don't really have an update. I know it's down pretty big right now, but a lot of like those metals, the rare metals are not doing so well. Like my favorite palladium.
Yeah, I think the big takeaway highlight, China's cutting rates to obviously try to incentivize some form of economic and industrial production, and until we start seeing that show up in the data, a lot of these, to your point, just won't get inflection in.
Yeah.
So that's kind of like the theme.
Will change.
We change, yeah.
Right, I think Keith really more thought of that whole rate cut as trying to get right, saying that right, so they want to
Try to get things,
things rolling. We'll see what the data starts to change. The point I think is this is the worst quarter in terms of GDP, but will it come back? Will it not? Like this again, we just really rely on that signal.
kind of wait and see, right?
Kind of wait and see. Although our current short on it is
well, that's been great. Yeah,
doing pretty well. So we'll see what happens here.
And later today, quick little plug, we do got Texan Rooster, I believe.
Yeah, morning, boys. We got a busy day today.
Yeah.
We got Texan Rooster up, coming up at 11:30 today. We excited?
Oh, pumped. Let's go,
I'm
baby.
pretty pumped. I think I have actually some interesting data here.
You have interesting data? Hope so.
Apparently that's why they hired me.
Yeah, we're working out the kinks on this show. We appreciate everybody tuning in. It's been a lot of fun to figure this out. It was a new format, and we're really excited about these guys and everything they bring to the team. We love having them, and I appreciate them with putting up with me, dragging them around, trying out new things. So.
No, we appreciate you. It's fun. Join us today at 11:30.
Yeah, we'll see you at 11:30, guys, and just pay attention for an email that'll hit your inboxes soon for a link to today's show. Have a good one out there.
Oi! 7 o'clock. Time to feed the cats. Make some coffee. Pinduo, are you sucking more? Are you suck? Oh wow, yeah. I mean that's the other problem with negative gamma. Alright, yeah, we're gonna dump the banks. That was foolish. Alright, let me check out Freeport. Freeport looks like it's at the bottom of its range. It may sell off a little bit more, but you could probably add a little bit here. Not worry. So oil is on sale. No oil equities yet. Wow, even further puke on Pinduoduo. Kinda just want to get the hell out. Alright, I'm stopping out of PDD. I'm not dealing with that. Yep, fuck these China stocks. Buy a little boil, get some natural gas. Damn, tough market. Okay, so I'm down 26 basis points. S&P is down 91. Nasdaq's down 92. Dow Jones is down 85. I've got some green, but mostly red. At one point, I was like a little closer to like neutral to zero, flat for the day, but not right now. Okay, gotta go finish making my coffee. What else? What else? What else? XOP could be on sale. Could be. Maybe not, though. Russell 2000 values on sale. Boom. Oh, wow. Fuck. Getting worse. Great. Okay. Well, everything's almost red now. Alright, so my worst one is Tellurian and New Oriental Education. That's fine. Roku. Question with Roku is, do I hold this last little bit of it? I would probably say the thing about Roku is it could be oversold. Yeah, Roku could be oversold by today. Oh, now it's going up again. Okay, well, maybe not. Alright, I'll probably just hold it. Alright. What am I seeing? JP Morgan's on sale. Yeah, I see that you could be short financials, industrials, and real estate. It's like, I guess So if that's the case, let me get out of some stuff. Not much without using another day trade. Because I did buy KRE this morning. I just have a feeling Tellurian's gonna be bought. Yep. Now a 2.5% position in Tellurian. So that's, oh yeah, straight to the bottom of the day, low of the day. It's getting toasty outside. He's gonna make me all hot and sweaty. Alright, India's on sale. India just switched to bearish, but I'm gonna buy some. Everything's pretty weak. Natural gas a little bit even more oversold. I think that's fine. What the hell? I've seen this guy before.
Two pairs and a free quality eye exam starting at just $79.95.
The exam alone is worth
$59.
I mean, people deserve breaks, right?
Yeah, breaks. Book an exam today at americasbest.com.
Natural gas seeing a big move this week, up more than 7% on the back of labor disputes at two major liquefied natural gas facilities in Australia.
So I'm pretty sure this guy, Bill Perkins, was on like a Jubilee fucking like millennial video, and I think he defended like toxic masculinity or
Energy information.
maybe capitalism. But of course, it immediately devolves into like toxic masculinity because, you know, what are we gonna pretend like there aren't a ton of poor people and ugly people out there that need help? You know, we're gonna pretend like that doesn't exist. I don't know. We're gonna pretend like we didn't have a ton of people, you know, that survived and kept reproducing. Are we gonna pretend like that? We can pretend like these are all separate things.
Projecting record highs for production and demand this year. Joining us now is Bill Perkins, CEO of Skylar Capital Management. Bill, it's great to have you back on the show and to check in with you.
Yeah, it's great to be back.
I like that shirt.
What we found out, are those the reasons we saw these big moves in nat gas, which, by the way, were even...
Same hat that he wore on the Jubilee video.
I think Europe was all about the strike. That kind of spooked the market. You know, the market was positioned for them running out of space to inject gas, and then the rumors of a strike in Australia had everybody pump the brakes, and they had a huge rally. I think natural gas, you know, had a little bit of a sympathy rally, but let's face it, it's hot. I'm here in Austin trying to move my daughter into college, and one day heat doesn't make a difference, but sustained heat drives a lot of demand for gas power plants, and we've been withdrawing in the South Central, so taking gas out of storage, and so that we've changed prices based on that demand.
So then, is it safe to say that the bottom is in? Because remember, you came on earlier in the year, and you were still very, very bearish on nat gas and where prices were headed. Are we headed higher now?
I'm not yet ready to say we're going higher. I'm mildly bearish. I mean, the heat won't last forever. S&P does look loose. That supply and demand balances look loose on a weather-adjusted basis. And pretty soon we're going to September.
Damn, that gas fucking puka.
You know, it's not something to write home about.
Buy more. Buy fucking more.
Mildly bearish, I think the rally is overdone.
Okay. I mean, we've seen oil, and I realize the oil market is very different than the natural gas market. In many ways, they tend to trade for different reasons. But we've seen oil prices move back towards highs of the year. I guess walk me through more broadly some of the energy dynamics and how real the possibility of a reacceleration in inflation when it does come to energy prices is concerned.
Well, to the extent that oil prices drive inflation, and they do, I'm pretty bullish oil. We have record low inventories, recession or not, nominal crude oil demand goes up, and we haven't had this great investment in infrastructure for production. And so supplies are tight, the SPR is at record lows. I mean, you've heard it from more people than me that it looks pretty bullish. That being said, when you drill an oil well, you get some associated gas, and as people pick up drilling in the Permian, that gas is going to eventually, via pipeline, find its way into the Gulf Coast and actually be bearish natural gas. You know, natural gas for many producers is a byproduct.
Yeah.
They just want to get rid of it.
Yeah. So I'm curious whether you're going to disclose this or not, but how your performance has been at the funds this year. Because last year you had an incredible year. You had a triple-digit return type of year last year. And it would seem like, based on our conversations since the start of the year, that your calls have been bearing out.
Yeah, they've been okay. I would say that we're north of 120%. I mean, that is kind of an estimate. I don't want to get in trouble. There's so many damn rules and regulations that you can get in trouble for saying things. We're having a pretty good year.
Okay. One final question for you, and that is, you have SkyFi. It's a startup. You're aggregating and creating accessibility to satellite data in a bigger, broader way. You're basically democratizing satellite data. Curious how that's going, especially when I know that satellite data has been so important to you from an investment thesis standpoint.
Yeah, I think it's going very well. We've got a product out there that's working. We're seeing enterprise customers seeing the value of it at skyfi.com so that people can get access to the data. One of the things that we're moving towards is, instead of just giving the data, because a lot of people don't know what to do.
Hot.
They're not necessarily EIS.
Very hot.
Natural gas trading shops or oil shops or
coffee hot.
miners, is give them the insights.
That'll get me sweating.
Applications on top of it. And so that's coming out soon, and we're very, very bullish and happy to provide that.
Well, natural gas is giving back some of the gains that we saw yesterday. We've been stuck in this situation of ever-rising stockpiles. Yesterday, though, we got
just looking at the stuff behind this screen. So, like, dollar still, I guess, could come down, which would be good for natural gas. VIX, you know, who knows? Gold, who knows? Dollar yen, who knows? I mean, like, a dollar, who knows? S&P's getting towards oversold, but, like, it could sell off farther to reach that oversold. Nasdaq's got farther to come because it hasn't come down as much. And yeah, corn is oversold. Wheat's oversold. Fucking copper's oversold. Crude's oversold. Natural gas is oversold. So everything's oversold, and the dollar is the dollar's not where I would get long it.
Supply shock in Australia, a work disruption that could disrupt global supplies. Now, take a look at the volatility that we have seen. That the price of nat gas is at 40% from those April lows. You can barely see it, though, because we're down 70% from the highs that we saw last August. Our next guest is not looking for a big bump in natural gas. For more, we're joined by David McAlvaney, CEO and Portfolio Manager at McAlvaney Financial. I think some people who are looking for a turn in nat gas maybe got a little bit excited yesterday that maybe things were not so bleak. How are you thinking about it?
I'm certainly looking at it from a longer-term perspective. So the 70-80% decline off of last year's peak numbers were in order, and clearly we got overdone on the upside with the hullabaloo relating to Russia and Ukraine. We've corrected those levels. $2 looked pretty attractive to us, so we positioned pretty well at $2, and so coming off of those levels, I think in the twos, it's a constructive place to be a buyer. You're looking at something that is absolutely critical in the energy transition, and so this is something that I think people easily and quickly forget. We want to move to solar, we want to move to wind, but we can't do that. Not without a significant period of time, 3, 5, 7 years of very, very required use of natural gas. So here we are with probably the most critical energy commodity, and I think $2 is a great range. $2 to $3 is a great range to be building positions.
I apologize. I sort of misconstrued your view. You are sort of bullish on natural gas here at these levels, and is that are you playing that through specific companies?
Yeah, I mean, certainly we like we like a lot of U.S. production, and the differentials between the U.S. pricing and European and Asian pricing certainly provide some opportunities, and that's what we saw yesterday with a significant move higher in natural gas prices. But I think in the final analysis, it's the consistency of production here in the U.S. and it's our required energy uses that make it very attractive at these levels.
And those that argue against a meaningful move in natural gas will just point to the huge stockpiles.
Oh, we have huge stockpiles. There's no doubt. I mean, I think from a supply and demand perspective, there's other commodities that are more interesting. And we could talk about copper, and that has an even more compelling supply and demand scenario. But I think this is where pricing moves from one extreme to the other. And so if you're looking past the current supply and demand dynamic, again, this is where you would say we've moved from $10 to $2.
3% position in Tellurian. I'll probably chill with this for the rest of the day.
Where you would want to build a position. And does that mean that we have a catalyst for growth? No. So clearly there's an overhang of supply, and that will remain the case for some time. But again, when do you buy? I prefer to buy when things are cheap than when they're expensive.
So let's talk about copper then. Since you mentioned it, how does it fit into that lens?
Yeah, CapEx in the space has been less than needed to keep up with the energy transition, and so we're dealing with sort of a massive demand component, which is sitting there ready. There's political will for us to move to greater electrification, and it simply can't be done without a 5 or 10 times supply delivered to the market, and there is no ability to do that. So I think we're looking at a really interesting setup for copper for many years to come, and anytime it's weak, that's something that should be bought. So I think the bigger story in the immediate for copper is the under reserving, if you will, in China, and I think we're getting ready to see a significant push in terms of stimulus there. The economy is awful. We can't seem to see the consumer return post-COVID, and the government, being centrally planned, has a GDP target which they are determined to meet. So the quality of growth this year, I think, is going to be pretty trashy as they go back to infrastructure.
Pretty trashy.
And so I think copper is sort of in the catbird seat to see significant Chinese stimulus. And again, this is when you set a target in a command and control economy, you will get to it. The question is it quality growth, not quality growth? I think at this point they don't care. So they're back to the bad habits of stimulating growth, and in this case, infrastructure wins. And you've got a number of industrial commodities, copper being one of them. So that, to me, I think actually Chinese stimulus is a bigger catalyst for copper than sort of the green and energy transition story, which is clearly a long-term benefit.
Deep.
Business has been going great. We've grown so much, so fast.
Yo,
What the bro? Hold on. Let me go ahead and say I already know. Chat. You just watching. There's a lot of media in here right now. There's a lot of boomers in here right now. There's a lot of everybody in here right now. Okay, listen to me. Okay, first of all, I want to go ahead and say, still taking this whole thing in right now, chat. Bro, this is fucking insane. Listen,
14 months blood.
look, for those who think this is about to be a quick stream, bro, I mean, for those who think this is about to be a long stream, it's not about to be a long stream, bro, I'm not gonna lie, bro, I'm here to
Bro.
talk a little bit, say what I gotta say.
Bro.
I'm out of here, okay? Listen to me, bro. First thing, oh my gosh, bro, this is a lot, bro. It's a lot of shit going on. I'm going right here, bro. Let me turn my food counter off right now because, you know what I'm saying? Let me turn that off real quick. Listen, chat, we're not even about to drag this whole, we're not even about to do too much talking. I'm gonna say what I gotta say. I'm gonna be as serious as possible, and I'm gonna be as mature as possible when it comes to this, okay? Everybody, please.
How has Shopify enabled your business to scale?
Shopify has enabled my business to scale in so.
Shut the hell up.
Please listen to me. Anybody who's finding me for the first time, whatever it is, listen to me. You're not stuff like that. Okay, first things first. Y'all already know. Y'all already seen everything. Okay, it's on international news. This took a goddamn. Bro, this is crazy. Okay, I'm gonna go ahead and say what I gotta say real quick. Alright, chat. Being from New York, it has literally always been, ever since I started everything like this, bro, it has been my dream to want to give back to the community that made me who I am, bro. That's always been my whole, like, you know, I feel like everybody can, you know, whoever is in a big position can agree that wherever you come from, you want to give back to the community and you want to do nice things. You feel what I'm saying? But after Friday, bro, I've come to realize the amount of not only power but influence that I have on people. You feel what I'm saying? I've come to realize that, bro, and I'm saying that to say this. I am beyond, bro, disappointed. Beyond disappointed that anybody who became disruptive that day.
Yeah, you were in danger, sir. I think disappointed is shit. What do you, I don't know. I mean, yeah, fuck. Yeah, I mean, your fucking audience is a bunch of kids. Alright. Case closed. Figured that one out. Got him.
In this video, we are unfolding the outlook of housing market, a realm of soaring dreams and shattering realities. Its attraction as a safe haven for investment has been tempered by a harsh truth. Crashes can happen. Memories of the 2008 financial crisis still linger, where homeowners were left in turmoil and the global economy took a devastating hit. However, amidst the chaos, there was one person who stood out: Michael Burry. Michael Burry accurately predicted and profited from the collapse of the US housing market, earning investors a staggering $700 million. Even before the financial crisis began, Burry himself made a personal profit of $100 million. Now, this renowned investor has once again raised concerns about a potential future housing market crash. In this video, we delve into Michael Burry's predictions and insights into the current state of the housing market. The most recent and notable housing market crash occurred during 2000s. It originated from the housing bubble, characterized by the rapid increase in housing prices, fueled by speculative investments and a surge in subprime mortgage lending. Subprime mortgages are loans given to borrowers with relatively weak credit profiles. The aftermath of the subprime mortgage crisis was devastating. When the bubble burst, housing prices began to decline and borrowers defaulted on their mortgages. That leads to a wave of foreclosures. Financial institutions heavily invested in mortgage-backed securities faced immense losses, some even collapsing, and the stock market experienced a severe downturn.
Buying moo, agribusiness, moo, na.
Overall market stability. Now, as rising mortgage rates and the possibility of a recession loom, buyers and homeowners are once again pondering the familiar question: is the housing market on the verge of another crash? When considering the potential for a housing market crash, it is crucial to analyze various factors that can influence its trajectory. While Burry's predictions are influential, it is essential to evaluate the broader economic landscape and additional indicators affecting the housing market. The first factor to consider is interest rates. The Fed had maintained near zero interest rates throughout the coronavirus pandemic, while providing stimulus packages to support the economy and households. During its recent meeting, the central bank decided to raise its benchmark interest.
I am down 20 basis points. The S&P is down 84.
Rates to a range of 5% to 5.25%. This is being done in an effort to combat inflation, which is at a 40-year high. However, the consequences of this rate hike policy are becoming evident, with the housing market being particularly affected. The sharp increase in interest rates are now more than double the levels which we have seen in 2020 and 2021. This surge has made mortgages more expensive, leading to reduced affordability and dampened demand for homes. Therefore, the housing market is experiencing a decline in prices, exacerbated by a significant decrease in buyer demand. These developments have raised apprehensions about a potential crash in the housing market after a period of remarkable sales activity lasting for 2 years. The second factor to consider is housing demand and affordability. Affordability is a critical factor in determining the sustainability of the housing market. The Fannie Mae Home Purchase Sentiment Index, HPSI, has experienced a significant decline over the past 4 years, indicating a decrease in consumer confidence in the housing market. In May 2019, the HPSI reached its highest level at 92.0, but now standing at 66.0 in June 2023, marking a nearly 39% decline from its peak. This decline suggests that consumers have become less optimistic about the housing market, which can have implications for house affordability. The decline in the HPSI can impact house affordability in multiple ways. Firstly, decreased buyer confidence resulting from the lower HPSI may lead to reduced buyer demand and potentially drive down housing prices. Secondly, concerns about housing affordability can contribute to the decline in consumer confidence. If potential buyers perceive homes as less affordable, they may hesitate to enter the market or delay their home purchase decisions, impacting overall housing demand and potentially slowing down price appreciation. Lastly, factors such as rising mortgage rates or stricter lending standards can also influence the HPSI decline. Higher borrowing costs and limited mortgage availability can make home ownership less affordable for some buyers, further contributing to the decline in consumer confidence in the housing market. Mortgage interest rate is our third inflectional factor. After a period of robust growth in home sales and rising prices, the housing market has experienced a notable slowdown since last summer. The slowdown can be primarily attributed to the substantial rise in mortgage interest rates. These rates have remained elevated due to the Federal Reserve's decision to raise its key interest rate by 25 basis points on May 3, 2023. The central bank's objective of controlling inflation has led to a consistent series of rate hikes starting in March 2022, when the 30-year fixed mortgage rate surpassed 4%. As a result, long-term home loans, including 30-year fixed-rate mortgages, reached a peak of 7% in October, marking the highest level in 20 years. Throughout 2023, these rates have remained around the mid-6% range. According to Freddie Mac, the average rate for a 30-year fixed-rate mortgage as of June 15 is 6.69%. Since mid-2022, this continuous increase in mortgage interest rates has significantly impacted the affordability of homes for potential buyers. Eichelberry has frequently expressed his concerns regarding the possibility of a housing market crash. In a previously given interview to Fox News, Burry discusses the relationship between interest rates and house prices. According to Burry, when interest rates are high, it can result in a drop in house prices. This occurs because when individuals consider buying a house, they often look at the monthly mortgage payment they will have to make. The majority
Gotta seal it up for the hot day.
base interest rate. As a result, borrowers are required to pay more interest on their mortgages. This increased interest burden reduces the amount of money potential buyers can afford to pay for a house. In other words, they can only qualify for a lower mortgage amount, which in turn decreases the price range they consider when purchasing a house. Burry highlights that this situation tends to accelerate the downward pressure on house prices. When buyers can only afford to pay less for a house due to higher interest rates, it puts a downward pressure on prices in the housing market. This can lead to a decline in house prices overall. Adding to his concerns, Michael Burry once again issued a warning that the U.S. economy is likely to experience a recession this year. In a tweet on January 2, 2023, Burry stated that although inflation has already reached its peak, it is likely to rise again as part of the same economic cycle when the economy slows down and the U.S. Federal Reserve takes action to stimulate growth. He expects the Federal Reserve to eventually cut interest rates in order to foster economic expansion, which could result in another surge of inflation. Burry emphasized in his Twitter message that the current peak in inflation is not the last of its kind, predicting the possibility of a lower or even a negative consumer price index in the latter half of 2023, potentially leading to a recession by any definition. He also anticipates that the combination of interest rate cuts by the Fed and government stimulus measures could fuel another round of inflationary pressure. Burry's warning about a potential recession has dire implications for the housing market. During a recession, consumer confidence tends to decline, resulting in potential homebuyers becoming more cautious and hesitant to make significant investments, such as buying a house. This reduced demand for homes can lead to a slowdown in the housing market and potentially cause a decline in home prices. Recent data from the National Association of Realtors indicates a decline in home prices. In May, the median price of an existing home was $396,100, down by 3.1% compared to the previous year. Moreover, the median price of a new home in May was $416,300, reflecting a 7.6% decline from the previous May. Finally, Burry's concerns regarding the housing market revolve around two key factors: the influence of interest rates and looming possibility of a recession. An increase in interest rates can have a detrimental effect on affordability, thereby exerting downward pressure on housing prices. Moreover, in the event of a recession, consumer confidence tends to wane, resulting in decreased demand for homes and a potential decline in prices. Adding to these apprehensions and the recent decline in home prices, which serves as a red flag for a potential slowdown in the housing market. This downward trend in prices further underscores the need for caution and raises alarms about the overall stability of the housing sector.
There's so much possibility exponentially grow.
For the HD selling off, and then I have a couple in Temecula opening up. Temecula, Marietta, even Hemet. But if you want anywhere there, I think I have one unit in all of those places coming available in the next month or two. Friday, Yeah, I'm glad the options went down. Again, a couple of things, but let's see if this all continues. Metro on Saturday, baby, California, coming home. August clapping my LT. It's okay. We'll come back. And hopefully, like I said, I'm glad we got cash. Like that, we don't have enough cash, but shit, I'm glad we at least saved it up instead of trying to buy these half-ass loads. You know what I'm saying? Or that's what I'm saying. Is just everybody's like, should we buy this? Should we buy this?
Roku ripping.
Let's wait a little bit.
Roku, big rip.
Good, we'll be straight. Do you ever buy 2-bedroom? Oh, I buy everything, dude. Again, it just all depends on what it is, but the more bedrooms, the better utility. But yeah, as long as I go for value, I don't really go for anything else. How do you spell tissue? T-S-H-A. It's called Taisha Therapeutics. I call it Trisha. Do the same Taisha. But it's good. Just be careful. It's up again. It's up like 100% since we bought it, I think. So I already took my bag off of it, but just be careful there. Nibble the little. Everyone keeps bringing. So O is on the list as well. That's why I'm like, hey, there's a reason why we got cash. But like, you guys realize O has gotten its knees taken out. So that's like another if anything, O is a little bit more uglier than NPW now, when you look at it there. But it's like, they're, again, obviously I'm speaking on short term. But again, real estate and a lot of these things got murdered. Oh, it's clap. Very clap. IOQ is going crazy. This thing's at 8. Didn't we trade this at like 11? Damn, or 10? Yeah, that thing's still at 16 bucks. And then Genrack's coming up. Any books? I'm new to this. I mean, are you trying to learn the right way, or do you just like want to learn? Like, I don't know. Have you ever seen me buy the Berkshire Hathaway share? Like, you know, like we could buy and flip shit. Like, you can just buy something, sell it. If it goes up, you make money, or you lose money. You know what I'm saying? But here's the deal. It's like, if you really want to learn about investing, this goes back to, again, like I yell at you and tell you to save money. Go read a book called The Intelligent Investor by Benjamin Graham. And Mr. Benjamin Graham, he was the mentor to Warren Buffett. So Benjamin Graham taught Warren Buffett everything he knows. And it's a book written by Benjamin Graham. And I encourage you to read it. It's very dry, it's very dense. However, it's probably the best investment book in the world. I guarantee you, if you give it as much effort as you would to reading Wall Street Bets, it's not going to be as entertaining. But like, if you like actually read through it and listen to what is being guided and the information that's being provided, you learn a lot.
Gonna end it. I'm only down 15 basis points. The S&P is down 86. So I'm outperforming, but I'm down. So that's fine.